You've really been one of the first industry insiders to be talking about the fact that retirees have maybe been taking on too much risk with their superannuation. You talked about the overexposure to equities and the dangerous investment environment that you see. What's the reaction you've been getting as you've moved around with that message?
I think behind the scenes people understand it, and to a lot of foreign fund managers and commentators, it's absolutely obvious that the problem's there. I think it comes back to the default option system, and so I think it needs a lot more tailoring and education for the individual about how they should set themselves up. I've no doubt that the problem is there. It would be a magnificent thing if we had a broader allocation of assets in our superannuation funds. I mean, a capital market is at its optimum when the holders of securities have a wide range to choose from, and the issuers of securities have a very wide range to choose from, because all of their circumstances are different. So we're just putting too many eggs in the equity basket for many, many reasons. And how that gets resolved, I don't know. But I'm wary about a system in which so many people just take a default option.
Judith, what's the real-life impact of this? Because you're our voice of retirees today as chairman of National Seniors. We hear of people delaying their retirement, maybe even having to go back to work. But what are you finding in terms of how widespread that experience actually is?
Well, Brooke, maybe I can just start off by saying how excited my organisation, National Seniors, is to be in partnership with Challenger in this space. And dare I say it, I think I see a few people over 50 in this room, and National Seniors, we're the voice that represents you. And it is for over 50s, so it's for people working, people who are part-time working, people with frail elderly relatives. So, we're really there out in the advocacy space. Look, I think the key thing is that people are interested both in adequacy, but they're also interested in some certainty or reliability. You probably don't want me to say this, Brooke, but the truth is they probably don't want to be waking up in the morning and being worried about what's happened on Wall Street overnight. That actually they're looking for a range of products that does generate greater certainty. I think from a public policy point of view, there's been so much emphasis placed on the accumulation phase of superannuation and not nearly enough policy concentration on that, the retirement income phase, the pension phase. And so we really want to play a role in that.
So retirees are blaming the government for this? Do they think that they should have... Australians are notoriously very disinterested in our superannuation. We're not as engaged as perhaps we should be.
Well, I think we've engaged in a kind of grand experiment where we've made assumptions about both the financial acumen of all these millions of superannuation holders, but also their kind of interest in it. So, there are a lot of our members who, they're not greedy, they're not unrealistic, but they do need some certainty, as the Challenger advertisement, I think, really points out, that, that the bills come in with a high degree of regularity. So there needs to be some matching of their retirement incomes with that.
Jeremy, what do you see as some of the problem areas in the way that we are handling the retirement phase?
Well, we're now realising that accumulation was the easy part, and I think David has explained to us just how expensive retirement is. Accumulation and retirement solve for entirely different problems, and we sort of underestimate, I think, as people age and their sort of regular wage check switches off, just how averse they are to loss. And I think we're now again starting to understand the financial dynamics of retirement. When you're not contributing and when market volatility happens like this, you end up doing a sort of a reverse dollar cost averaging and watching your capital just eroding away. And the other thing is it's about the income profile. So don't tell me about the investment return that my product's going to earn. Tell me about the shape of the income that I'm going to get? When's it going to come in, and what's it going to look like? And sometimes people talk about living off dividends. The trouble with that is you only get 2 paydays a year. For the average person, that's a very, very difficult ask. And of course, we've still got a lump sum system, and unfortunately, what that does is it means that most people have got no idea either what they're going to need by way of income in retirement or what they're going to get. And the sad truth is, and I think again some of David's comments reinforce this, the reality is that most people are vastly underfunded for what retirement's going to cost them.
We will all spend probably quite a long time in retirement because we're living longer. So this can't be about hating shares though, can it? Because we also need the exposure to shares over that longer term to get the growth, don't we? I mean, we can't kind of fly the we hate shares flag too much. This is all about a balance, obviously.
It just depends what order you do it in. So really, what we know is that the gap between the age pension and what you need to live modestly or comfortably is quite sizable. So you've got to actually immunise that, get some concrete security over that. And of course, if you have wealth over and above that, then of course you need exposure, depending on your risk appetite, of course, but of course then you need exposure to growth assets.
Judith, we hear references to the crisis of confidence in super. Is that something your members talk about? Do they relate to that kind of statement?
Well, we have...
how bad is it? I guess I'm trying to get to yet.
It's hard to say this, but I think there is a fear, because in some ways it's good, but there's almost a fear of living a very long time.
Yeah.
And that, their financial resources will run out before they run out. So I do think that there is an appetite for some sort of risk management products in respect of that longevity. People are seeing their parents live a lot longer. They then realise that they'll, hopefully, of course, live a lot longer. But, they want to do that with a degree of security and comfort. So I do think that longevity risk, coupled with, obviously, the volatility in the investment markets in the past few years, has really created a degree of anxiety amongst our members. They're always... I'll give you an example. And this probably doesn't surprise this group. They've reacted very badly to the carbon tax package. And when I say to them, there's compensation, it's just, I think, that additional uncertainty, anything that's seen to be adding to cost of living, will the compensation keep going and the like. And so I think that is just emblematic of how a lot of older people think.
David, maybe the message that you were delivering earlier about governments is getting through to people.
Well, it's not getting through to governments yet. You just can't buy votes with debt. That's the simple rule. But let me just... one of the reasons for the issues that Judith and Jeremy have just discussed is that the financial literacy in Australia is at quite a low level. The Commonwealth Bank Foundation did a very large study with Monash University some years ago in which we found out that if Australians could lift their standard of financial literacy from where it is to below the knowledge of compound interest, GDP would rise by $6 billion a year. That's not even at compound interest. As soon as you're in retirement, you're in compound interest. So the advantage here, so you see the problem with a default fund. The advantage, if you're in the advice business, is to work out how to use intelligent systems to deliver advice and education to people about superannuation. So good advisors will do that with their clients' interest in mind and with a view to deliberately upgrading their standard of financial literacy. Because if you want to hold... the only way that you can reliably get the return on equities that the long-term averages suggest you can get is that you've got to be very patient and not need the money, and you don't need liquidity. They're the two conditions. Now, if the workforce is still retiring early, then the period that you're in employment is shorter and therefore has a higher probability of having an equity shock in it.
I mean, I take what you say, David, but in a sense, I think the language is quite problematic because, yes, I think you can't assume that the average person is particularly financially literate. But think about the term default. I mean, to many people that will imply low risk, kind of middle of the pack.
Yeah.
You know what a wise person would recommend. And in a sense, what you're saying is that language is actually quite misleading for people, and that we need to be more explicit in what is actually being sold to people. But if you go into the industry super funds, that's the language. And I don't think a lot of our members have quite realised.
I agree with you.
They just haven't realised what risk they were bearing. And you see, and the trouble for
in my view, it would be the other way around. The default should be 30-70, not 70-30. And then with education and good advice from their advisors, people should understand if they want to do something different, what the trade-offs are.
But I think also the trouble is that, when we hear this kind of cliche about superannuation being a long-term investment and the like, well, of course, that doesn't actually appeal very much to my members because, they're actually about the here and now and what it's going to provide. So, in fact, I think that's this kind of message which is really, over-emphasised because, for many people it's actually about making the most in terms of retirement incomes of what they've got.
Jeremy?
A couple of observations. I've just been in the UK and they've got a new pension scheme for workers who, for one reason or another, have missed out on having one. And I looked at the asset allocation. It's just a big default scheme, really, and they've done exactly the reverse. They've gone to a very low-risk default to begin with. And I suppose the other problem with our system as it stands at the moment is we've got basically 20-year-olds and in some cases 74-year-olds with the same asset allocation. And it's about time we started looking at age-based defaults and all of. I know there are issues with those things, but we really can't ignore them.